Hi everyone, so for today's video I'm going to go over 5 great Canadian dividend stocks that have very strong balance sheets, are classified as dividend aristocrats, and in my opinion will see minimal volatility and damage in the current economy. If you find something beneficial or informative throughout the course of the video, go hit that subscribe button, go hit the like button, I'd really appreciate it. It'd mean a lot to me. Throughout this video you'll recognize a trend in the companies I've picked. They are all highly diversified. Medium to large cap companies with firmly rooted grounds in Canada. Really have seen it all. They're all older companies, and I think you will find that these companies really are here for the long haul. With current yields being so unpredictable, maybe stagnant, maybe going down in the future months, these companies really do provide a cushion to your portfolio, giving sustainable, stable, and reliable dividends that I can't see being cut anytime soon. These companies are also poised to see substantial capital gains. So with that dividend, you're also getting a surge in valuation of stock price. All right, no time to waste. Let's get right into it. So the first company I want to talk about is one of the largest insurance companies worldwide. It's the largest insurance provider within Canada, Manulife. Manulife is a multinational insurance company based here in Canada. It was founded in 1887, so it's definitely seen its fair share of turmoil, ups and downs. Like I can think of at least 3 things that have happened since 1887, at least. So, you know, this company really does know what they're doing. They're here for the long run. Manulife is a massive company. They almost have $1 trillion of assets under management. One thing is clear during all this turmoil, and that is that the financial industry, as it always does, will come out ahead. They really will. They will benefit directly from this health situation, whether or not you like it. Okay, so Manulife's market cap is $36.307 billion, making them a large cap company with quite an appealing price to earnings ratio of 8.04, which is quite low for the insurance industry. Its forward P ratio is projected at 6.30, even lower, and a price to book of 0.71, indicating the stock may be undervalued. It has a relatively low beta value of 1.17, however it does have quite a high 52-week spread of 27.78 and a low of 12.58. Keep in mind that most of this was probably due to the full market sell-off in March. It has a relatively low profit margin of 5.73%. However, I think the damage to their bottom line is already done. They do, however, have a measly return on assets of 0.52% and a return on equity of 8.33%. While this isn't the most spectacular balance sheet of all time, this is not what we're specifically focused on here. We're looking for dividends, passive income. They have $64.27 billion in cash, so they will not go under anytime soon, if ever. They have a forward dividend yield of 6.04%, and these are yields that I'm not sure the market will match for the rest of the year with all the uncertainty with the Roni. Analysts have placed Manulife at a 2 out of 5, 1 being a strong buy, and the current share price is below the target price of $22.82. So capital gains can be potentially made on your investment as well. I see Manulife and the financial sector at large a very safe place for your money right now and a reliable source of dividends. The next dividend company I want to talk about isn't exactly a company, it is a ETF called iShares S&P TSX Canadian Dividend Aristocrats Index ETF under the ticker symbol CDZ. By definition, a Canadian aristocrat dividend company is a company who has increased their dividend payout for at least 5 consecutive years. So it pretty much gives investors assurance that this dividend isn't going to be sliced anytime soon and that they do have the earnings to distribute back out to its investors. This is one of my favorite ETFs I personally own. It pays out dividends on a monthly basis, which is awesome. It's a great form of passive income. Every month you get that dividend. So it's really reliable. It offers a drip program where you can put those earnings back into the company to buy shares. And I really do like currently being situated primarily within Canadian companies. So we can see they have a PE ratio of 11.58, a sweet distribution yield as of June 22nd of 5.50%, which is really nice. And this is monthly, so it's just really passive income into your account. Their price to book is 1.47, and their trailing 12-month yield is 4.71%. This also comes with the management expense ratio of 0.66, so make sure you price that in. It's extremely diversified, and even more importantly, it's more evenly weighted, with not one company allocated more than 2.5% of its total holdings. It's primarily centered in financials, utilities. However, you can see that it's well diversified across different sectors. CDZ did take quite a hit in March, we can see, but with it being so heavily diversified, I really like this ETF in the coming months and years, and I think it is going to be a safe haven for money throughout all this turmoil that we are currently experiencing. It's a great bang for your buck. The third stock I want to talk about is Algonquin Power and Utilities. It is one of my favorite utility companies. I really like them. They're focused on green, clean, renewable energy, specifically solar, wind, and hydroelectric. It is a relatively new emerging utility company based in Oakville. They started in 1988. It operates through two different subsidiaries, Liberty Power and Liberty Utilities. Okay, so Algonquin is technically a mid-cap company with 9.527 billion in outstanding shares, an extremely reliable share price with a beta of 0.34, a somewhat high PE ratio of 25.51, and a slightly lower forward PE of 23.57. This may suggest that the share price is currently somewhat overvalued. It has a fantastic profit margin of 23.42% and a return on equity of 7.71%. It reported $709 million in gross profit, has $197 million in cash, however has more liabilities to assets with a ratio of 0.91. Its price to book is decent at 2.75, but most importantly, let's get to the divvies. So we see a yield of 4.66%, with a quickly approaching ex-dividend date of June 29th, so get in before that if you want the next dividend. Recommended trends puts AQN at a 2.5 in between buy and hold, and a price target slightly lower than its current share price. I do really like this company. I think they have tons of room to grow. They're a company I really believe in. I feel good putting into green, clean energy. It's the way of the future. I do want to be personally exposed to this renewable energy form. The fourth high dividend paying Canadian company I want to talk about is the largest bank in Canada. Can you guess what it is? It's Royal Bank of Canada. As I said before, the financials are going to come out ahead of this. I think financials are a safe haven for your money right now. They are too big to fail, and they are paying out huge dividends in comparison to many other corporations. I think you are kind of good going with any big bank within Canada right now. I specifically just latched onto Royal Bank, and she's treated me well, so I'm gonna just share the wealth. It's got a nice place in my heart. Royal Bank has a massive market cap of 131.78 billion, a 52-week high of 109.68, low of 72, with a relatively low beta of 0.72. And their awesome dividend ratio is sitting at 4.61%. It has an appealing PE ratio for the banking industry at 11.86 and a similar forward PE of 11.06. Its price to book is nice at 1.66 and has an unreal profit margin of 27.33 and a great return on equity of 13.73%. They reported a trailing 12-month gross profit of 44.14 billion, have 697.22 billion on hand. How are ya? And reported 11.452 billion net income. They are currently sitting at a 2.2 between a buy and hold, and its current share price of 92.60 is lower than its analyst price target of 98.25. I really do think this is a safe dividend, and I can see these banks, especially the ones that are doing fairly well on the balance sheets right now, continuing to increase their dividends so they can remain a dividend aristocrat. All right, moving right along, the fifth high-paying dividend Canadian company I want to talk about is Nutrien. Nutrien is a fertilizer company based in Saskatchewan and is actually the third largest producer of nitrogen fertilizer in the world and the top producer of potash in the world. Nutrien owns over 1,200 stores worldwide. They really are based all over the world. It's really crazy to see how diversified this company is. Nutrien is a large cap company with 27.137 billion in outstanding shares, a low beta of 0.67. I think you're starting to see a trend. A forward PE of 21.10, a low price to book of 1.23, a low-ish profit margin of 4.65%, and a return on equity of 4%. They currently have 3.18 billion in total cash and a current ratio of 1.07. They also almost generated $1 billion in net income for 2019. Their projected price target is above their current share price, so you can make some gains while capturing that sweet dividend yield of 5.25%. They do remain undervalued right now, and although their future doesn't remain as crystal clear as some of the other companies, I do think this is a good buy. However, keep an eye on its share price long term. Alright guys, that's it. Those were my 5 picks. Please like and subscribe. I'd really appreciate it. Hope to see you guys next time. Hope you enjoyed the content. Do your own due diligence in comprehending whatever stock you may be choosing. It really does benefit you knowing which company you're picking. So do your research, go through their balance sheets, learn a thing or two, and I will see you guys next time. Cheers.